Olá, sejam bem-vindos e bem-vindas a mais um Infomoney Entrevista. Eu sou Mariana Segala, diretora de redação do Infomoney, e hoje recebo um dos investidores mais aclamados da atualidade, Howard Marks, fundador da gestora americana Oaktree e conhecido pelos seus memorandos mensais em que discorre sobre temas de economia e de mercado, lidos por investidores de todo o mundo. Ele conversa com o Infomoney sobre comportamento do investidor, sobre bolhas de mercado, sobre ciclos econômicos e muito mais. Sr. Howard Marks, seja muito bem-vindo e muito obrigada pela entrevista.
It's a pleasure to be with you today. Bom dia.
Com base na sua experiência, que conselhos que o senhor costuma dar aos investidores que se mostram preocupados com a volatilidade atual do mercado e que querem preservar o seu patrimônio no longo prazo?
Well, first of all, Mariana, volatility is inherent in investing, and volatility, that is, fluctuations of prices, should not be of any concern. You shouldn't invest in something where you can't survive fluctuations, because fluctuations will happen. But what really matters is what happens in the long run. Is it a good company? Does it grow? Does it have success? Does it beat its competitors? If you made a loan or bought a bond, is it a company that will repay you? Does it have financial stability and security? These are the important things, not whether things go up and down. Now, people pay too much attention to volatility, and in particular, they get scared off if prices are volatile. Volatile usually means if they fall. Nobody complains about volatility on the upside. They're worried about volatility on the downside. But if you think about it, if the price of something falls due to events in the environment not related to fundamentals, that's like the fact that it went on sale at the store. People should not be discouraged when something goes on sale. They should be excited when something goes on sale. So I think that too many people care too much about the short run, and they should not be sensitive to a short-term volatility. They should expect it. They should understand that living with volatility is part of being an investor, and they should either ignore it or benefit from it by buying when things are on sale.
Em dos seus memorandos publicados no começo desse ano, o senhor explora o tema das bolhas de mercado e eu gostaria de trazer esse assunto para a nossa conversa. Quais que são os principais sinais de que existe uma bolha e como que os investidores podem se proteger quando percebem que existe uma a caminho?
Well, so far in this century, which is 25 years old, we've had two bubbles that burst. And the first was the tech bubble of 99, 2000. And the second was the housing bubble of 05, 06, 07. And of course, the first bubble was burst and was painful. The second one produced what we call the global financial crisis. And ever since then, people have been on the lookout for bubble. And you hear the word bubble all the time. Prior to those two, people were not as preoccupied with bubbles as they are today. Everybody's looking for a bubble. Everybody says, is this a bubble? Is that a bubble? Maybe it's a bubble. The thing about a bubble, it has two features. Number one, of course, security prices are high, elevated. Often that's because they have gone up substantially. And we have to, it's the inverse of things going on sale. It means there's been price increases. So investors should look at the price increase and say, well, do I really want to invest if there's been a price increase? And should I bide my time or should I wait? The other important element in a bubble is the psychological element. There's an excitedness. It's gone up so much. I think it's going to go up more. And if I buy it now, I'm going to get rich. The other emotional aspect of a bubble is the opposite. It's gone up so much, I don't own it. I feel really terrible that I haven't owned it. And other people have made money, and I didn't make money, and I'm so stupid. And if it keeps going up and I don't own it, I'm going to have to kill myself. So maybe I should buy it. I call that capitulation. And obviously, if you go through those two sources of strings of reasoning, number one, it's up, and maybe that means it'll keep going up. Or number one, it's up and I don't own it, and if it keeps going up, I'll be desperate. None of that makes sense. That's not a reason to buy something. You buy it because you think it represents an attractive value, because it's a company that you want to be a part of, and you think that the value, the real value, not the price, but the value of owning a piece of that company will keep rising. That's why you should buy a stock or make an investment. Not because it went up, so maybe it'll go up more. Not because it went up, and if it keeps going up and I don't own it, I'll be miserable. Those are not good reasons to invest. Those are emotional reasons, psychological reasons. And people, if they're going to be investors, and try to be active investors, that is to say, buy at some times, sell at other times, and trade and so forth, which is very hard to do and which I recommend against. But if they're going to do those things, they should not let the fact that something has risen influence their thinking. They should look for value and invest if they find a company they want to own a piece of, not invest because the stock has risen and could go up more. So a bubble includes this psychological aspect of FOMO, fear of missing out, and the psychological aspect of regret. These are the elements that turn high prices into a dangerous bubble.
Em entrevistas recentes, o senhor explorou a ideia de que pensar que o mercado está sempre certo é um absurdo, o que encaixa um pouco com o que a gente falou agora sobre bolhas. Como que os investidores podem desenvolver uma visão crítica e independente diante de consensos de mercado, especialmente nos momentos de grande euforia ou de grande pessimismo?
Yeah, how much time do you have? Do you have like 3 hours for my answer or 4 hours? This is a very deep question, and I, to do it justice requires a lot of time, but I'll try to do it in 5 or 10 minutes. I was very lucky. I attended the University of Chicago Business School. I went there in 1967, so almost 60 years ago when I started. And they have something there they call the Chicago School of Finance Theory. And I was very fortunate to attend at the time that the theory had just begun to be discovered and discussed. And the most important element in the theory, in my opinion, is something called the efficient market hypothesis. The efficient market hypothesis says that because there are so many investors in the market, and they're working so hard, and they're smart, and they're highly motivated, and they're numerate, and they have computers, and they're objective, and they're rational, their efforts cause all the information to be instantaneously digested and incorporated in security prices so that security prices are always right. And if security prices are always right, then you can't walk into the market and say, oh, you see that one over there? That one's too low. That one should be higher. I'm going to buy that one and it's going to go up. Or that one's too high. I'm going to short that one and because that one's probably going to go down. If the market, if prices are always correct, you can't make those judgments, or nobody can make those judgments successfully. That leads to a simplified conclusion. The way it's described is very simple. You can't beat the market. There are no bargains to find. There are no overpricings to avoid. You can't beat the market. And as you say in your question, Mariana, I think that's absurd. You can't say the market is always right. In fact, You look at Amazon stock. As I recall, Amazon stock was 99 or 90, let's say, in the year 99. And then in the year 01, it was 6. It can't have been right both times. The value can't have gone from 99 to 6. And today it's a couple of thousand. So maybe they were both wrong. But so I don't believe in the full efficient market hypothesis, but I do believe that other people are trying too. They're not idiots. So it's hard to find mispricings, but not impossible. In fact, I wrote a memo, maybe it was January of 2015, called On the Couch, because I said every once in a while the market needs a trip to the psychiatrist. And then I followed it up with one called What Does the Market Know? And because I published the first memo and everybody was saying to me, well, the market's going down. Doesn't that tell you that there's something wrong? So I said, the market doesn't know anything. I know more than the market. So I'm not going to let the market tell me what to do. I may know more than the market, or I may not, but there's no reason to think that it knows more than me. So I'm going to do what I think is right. I'm not going to sell because the market went down or buy because it went up. I'm going to try to figure out what is right and do that. Now, your listeners, your viewers are individuals who want to do investing. But my point is, they shouldn't buy because things are going up. They shouldn't sell because things are going down. But to be a successful investor, you have to understand what makes things go up or down in the long run and see if you can make those judgments successfully. It's not easy, but I think it's worth a try.
E há sinais claros quando o mercado está errado? O que seriam esses sinais?
Well, I think the times are when the market is moving on emotion. See, when the market moves on facts, a company is having great success. It's reporting rising profits. It's attracting talented executives. It's coming out with good new products. These are positive, real reasons. We call them fundamentals. Substance. But and that's what people should work on, not guessing what's going to go up tomorrow, and not guessing at what's going to be popular. You can do that with records. Which recording artist will people like the most in 2 weeks? But to try to guess which stocks they're going to like the most is very difficult, and I would advise against that.
Num mundo onde as informações circulam muito rapidamente e decisões são tomadas em frações de segundos, como que os investidores podem permanecer calmos e racionais para evitar decisões que sejam emocionais?
Well, how can they is difficult, but they must. You can't make serious decisions, as you describe, in a couple seconds. You wouldn't buy a house in a couple seconds. You wouldn't buy a car in a couple seconds. So why should you buy a stock in a couple of seconds? Now, the reason people do is, again, these emotional motivations. They say, oh my God, if I don't buy, it's going up so much and my friends have it and I don't have it. And if it goes up more, I'm going to be so disappointed. So I got to buy some. That's not a good reason to buy anything. And they have to resist. And you have to just say, there's no hurry. I'm going to make this investment. I'm going to hold it for a matter of years because I think it's a great company. So it doesn't matter if I buy it today or tomorrow or in a week or maybe even in a month, but I'm going to take the time I need to study it and figure out if it's really a good company. And again, why don't you buy a house? You see a house, a for sale sign, you walk in, you look at it, okay, I'll take it. Nobody does that. Why not? Because you have to investigate the neighborhood, the schools, the crime rate, who the neighbors are, how it was built, whether it needs any repairs. You have to do a lot of investigation. Same with a car. You don't walk into a car dealership. Oh, I never saw that car before, but it's attractive. I'll take it. No, you're going to read the reviews and check the history and all those things. That's what you have to do on investing. It's not like buying a shirt or eating a meal in a restaurant. It's a substantial financial decision that you should take seriously, and you should hope that it will work out successfully over a number of years. And if it is a matter of years, as I believe, then it doesn't matter whether or not you buy it today. And the idea, if I don't buy it today, I'm going to miss it because it's going to go up tomorrow. That's stupid. I mean, what makes you think it's going to go up tomorrow? The fact that it went up yesterday? What does the fact that it went up yesterday say about tomorrow? Nothing. So you have to get your emotions under control, understand what makes stocks go up dependably, and try to become part of that process.
E isso se conecta com a sua visão histórica de focar no longo prazo em detrimento do curto prazo.
Absolutely. You know, Ben Graham, who was a professor at Columbia and was Warren Buffett's teacher, said that in the long run, the market is a weighing machine, and in the short run, it's a voting machine. So in the short run, it runs based on popularity. You know, if there are 10 investors and 7 check the box for General Motors, GM stock goes up. If 3 check the box and 7 say no, it goes down. But you can't predict that. In order to be able to make any judgments predictably that will work, you have to understand General Motors and what it's doing, how it operates, and how it's likely to do in the future. And so, as I said, it's a serious study, and if you're not willing to do the study, you shouldn't expect success. If you rise and fall with emotion, you should expect unsuccess, failure. And if you're not willing to do the work and you want to participate, you can participate by hiring a money manager or investing in a fund or an index fund. There are many ways to do it. But, you know, for the individual to say, well, I like General Motors because I think they have great new cars and new management and new factory, and I think that the legislation on cars is going to be positive, and I think the ecology is going my way, and so forth. You can make those judgments, but it takes work. You shouldn't expect to be able to look. General Motors stock is selling at 52. It sells at 52 because there are 100,000 other investors, and they vote. Remember the voting machine? They vote every day that General Motors is worth 52. That's what all those 100,000 other people think. Who are you to say, no, I think it's worth 54. I'm going to buy it at 52 and make $2. And it's hard to do that and make money. But at minimum, if you're going to do it and expect to make money, you have to do the work to understand General Motors better than they do. Why should you think that a superficial glance at General Motors on your part will allow you to be a successful General Motors investor? You have to do the work. This is not a sport. This is not a video game. This is not an arcade. This is a serious pursuit with serious money involved. And if you went out to play basketball, you wouldn't expect to win unless you had studied basketball and practiced and gotten fit and so forth, and found some opponents you can beat. Same with the stock market. You have to do the work. You have to gain the knowledge and the expertise and be ready.
O senhor frequentemente enfatiza a importância de entender os ciclos do mercado. E eu gostaria de saber quais são os indicadores a que o senhor presta mais atenção para avaliar em que ponto a gente está de um ciclo econômico?
Well, first of all, as I said in answer to your first question about volatility, things go up and down. Every stock price goes up and down. The stock market as a whole goes up and down. The question is, what happens in the long run? The stock market tends to rise in the long run. In our country, the S&P 500 has returned about 10% a year on average for 100 years. So it has risen over 100 years, not consistently, not every year. There have been very dark periods. There have been periods when it went down and people got depressed, and if they sold, that was a huge mistake because it always came back. But there's an upward bias to the stock market and to corporate profits. So what happens, the reason that the market doesn't rise steadily 10% every year, but sometimes 20 and sometimes 0, sometimes 30 and sometimes negative, is because sometimes people get too excited and it goes up too much and becomes dangerous. And sometimes they get depressed and they sell and the market goes down and it gets too cheap and it becomes a bargain. So what I look for in assessing the cycle is what's going on in the behavior of investors. Are they excited or depressed? Are the optimists winning today or the pessimists? Is confidence winning out or fear? These are the things that tell me where the market is in its cycle. And where it is in its cycle tells me something about what's likely to happen next. It doesn't guarantee it. But I mean, if the market is being ruled by optimism and prices are high relative to fair values, then the normal expectation is that it's more likely to go down than up. But it may not happen, and it may not happen for years. So I think it's very important to know that nobody can predict these things in the short run, but where it stands in the cycle informs you about what's more likely to happen or less likely to happen. Now, and those things are mostly behavioral. They're related to emotion and its impact. So I think that that's worth looking at. Now, but again, it's hard to gauge the cycle. It takes work and study and expertise and discipline, etc. And so people should not expect to be able to do that casually and be correct. They can either ignore it and invest in the stock market and hold throughout, regardless of the cycle, because of the tendency of the market to rise over long periods of time. And that's much better for most people than trying to guess at where the market is in its cycle and be in or out. That's what we call market timing. And it's hard to do market timing correctly. So you can look for the behavior of others. When other people are crazily optimistic, I get worried. And when other people are pessimistic, I get excited. I try to do the opposite of their emotional mistakes. But the alternative is to just get into the market and stay in. And getting in and staying in and starting when you're young and investing and staying with it on autopilot on a consistent basis is much better than trying to jump in and out with market timing. Very hard to get that right. By the way, a little commercial. I wrote a book called Mastering the Market Cycle, and it is available in Portuguese. I think it's even available in Brazilian, if I'm not mistaken. And if people want to understand cycles and think they can achieve the knowledge and discipline to do it correctly, then I would suggest to people that they start with reading the book.
Eu agradeço pela entrevista mais uma vez, Sr. Howard Marks. Muito obrigada por estar aqui com a gente no InfoMoney Entrevista.
Well, it's my pleasure. I love Brazil and its people, and I'm a big believer in Brazil's future. And if I was a young person living in Brazil, I would want to have exposure to the Brazilian stock market, and I would want to go in through a money manager or fund because they're the pros. And and then the most important thing is don't leave it, is to leave it alone and don't mess up by trading too much.